There you go. We've got 25 participants. Let's give it a couple minutes or maybe a minute before we kick things off.
Still making
No,
talk. Come on.
yeah, no James today, unfortunately. He had got called into a last minute meeting, but we've got Rob Chrisman as a panelist this time. We've traded roles. Big relief for me. And we've got Ira Selwyn and Rob Kessel as the usual entourage. Uh, anyway, so the quick introduction. Sorry, this capital markets wrap is brought to you by Poly, where I work. Poly is a next gen product and pricing engine, where the PP is our core product. We've also got AI, data analytics, and our best API library and a loan trading exchange. If you got questions about us, you can always go to poly.io's website or email us at sales@poly.io. So why don't we kick things off with tariffs? I mean, at this point, tariffs is pretty much is a new
Isn't
slur.
it? You don't want to have any kind of like lighthearted, like talking about severance or 1923 or White Lotus, Marcus.
Well,
Does they
I don't know.
plunge right into tariffs?
Yeah, well, I'm currently traveling for work in a hotel room, but we went out to watch the NCAA championship last night, and what a game and what an ending. I don't know. I feel like that last play is going to haunt that guy for a while. The Houston.
Absolutely. And the Nuggets coach just got fired.
Oh,
Yeah.
um,
So Ira doesn't care, but it is
Was that
interesting.
but Rob, was that a Doge firing?
It could be. It could be. I don't know. We have news today that Fannie Mae, Bill Pulte under Bill Pulte's Fannie Mae fired 100 people who were for fraud. But Ira, as you and I were talking about a few minutes ago, there's no other reason cited. It's a little bit odd. Off with their heads.
yeah.
So
I mean, I would say like to your point, like if there's so much, there's no transparency. Is what I guess what I would say. It's questionable what's next. Um, I was going to dive right into tariffs. Hope that's okay with you, Mr. Chrisman.
there we go. Right. That's speaking of
Yeah, there
Ira.
we go. Yeah, with the proper intro at this point. What I was going to say is that tariff for me, at least, it's basically a swear word at this point. Every morning I wake up and turn my phone on and I drop a swear word somewhere kind of in my morning routine now. I mean, like what, and I'll start with you, Ira, like in terms of like investor demand, investor bidding, like what does this level of market volatility and uncertainty do to that rate sheet pricing?
Yeah, it's definitely not fun, right? Obviously, we always hate volatility, whether it be from, setting pricing to not knowing what the screen is or if it's going to move in, 5 seconds. Right now, we're starting to sell off through the afternoon again today. Um, when it comes to loan sales, your timing of your loan sales, your coverage when you're taking in new locks, all that is affected. If you're taking a lock in as an example, let's say you take $1 million of locks, today, right now at 3 o'clock, and then you need to add coverage 5 minutes later, when you have heavy swings like that, um, not only is your timing of your hedge coverage off, but you're subject to the wild bid-ask spreads. And we have a move like we saw yesterday or even Friday, where you're seeing significant movements throughout the day, up and down, trading on headlines or fake headlines or maybe fake headlines, and not being based on actual economic releases. It just it causes a lot of headache and turmoil and volatility. And trying to set pricing, trying to set bids, trying to sell loans, and not being caught at the lows or the highs, either or, doesn't make for a fun day. That's for sure.
Yeah, and this one's for Rob Chrisman. I mean, what are you hearing from? I mean, you speak to probably more lenders out there than anyone. And what's the general outlook? What's the general mood and strategy if there is one?
Well, it's interesting, Ira, when I was sitting here listening to you talk about uh, you know, the timing. I remember, don't you hate sentences that begin, I remember? But I remember when Countrywide used to come in every day at, I think it was 5:15 West Coast time, 8:15 East Coast time, and make their security sales for the day. And I remember when you talk to broker dealers who they'd rush to their desk, they try to get there by 8, 10 on the East Coast, and then they do their Countrywide business, and then they would go back out and, get coffee or get a donut or park their car or whatever. They had to get there by, maybe it was 5 a.m., 8 a.m. East Coast time. But anyway, and that was Countrywide's, that was what they did. They sold what they needed to sell every day at the same time. And all the broker dealers and the traders and the salespeople knew it. And that was just what they did. Um, Fast forward to now, and it's much more granular in terms of the hedging models, and you have a lot more information at your fingertips, but there's still that timing question about when you sell or when you pair off and when you do certain things. And if you look at the stock market, if you look at how people invest in the stock market, the old saying is something about as long as you're in the market, the timing shouldn't matter. I forget exactly what it is. Maybe Rob Kessel knows what it is, but it's not, if you're trying to time when you're in the stock market or when you're out of the stock market, when you buy stocks or sell stocks, it really doesn't, you're not going to hit it. Just being in the market in some sense is enough. When it comes to mortgage-backed securities and a pipeline, the generally speaking, on the trading desk, when we were hedging clients' positions, we would call up our clients, hey, Ira, you having a big lock day? Okay, then maybe we should put on some extra coverage. Oh, you're not doing anything, then I think we're good for the day, kind of thing. It was more monitoring what was coming in the door or not coming in the door, and you would add coverage based on that. Or, gee, we're hearing Fannie Mae or Freddie Mac, they're about to have a price change, so maybe we should do something. Or, somebody out there has advised, lock in today. And so business would pick up for whatever reason. And it is tough when you are trying to run a company. Getting back to your question, Marcus, it's tough when you're trying to run a company. You have so many other things to think about rather than trying to time the market to the minute. You as an owner or a CEO, you leave that in the hands of the capital markets person. And even then, the information is imperfect because you don't know in this era where you have headlines that happen overnight. You have political headlines that come in throughout the day. You just don't know what's next. There's no predictability. And so, as Ira said, when volatility picks up like this, hedge costs pick up and performance suffers. And so if I were to give one message to the owners who are on this call or the CEOs or the senior managers, it's don't expect a lot of, profitability or, whatever you're expecting from your capital markets team because of this volatility. When volatility picks up, hedge costs go up. When hedge costs go up, profitability goes down.
Yeah, no, it's great. It's great feedback, Rob. And kind of, I've got a funny anecdote on that. When I was at Opus Advisors, we'd always have loan officers call, like, should I lock right now? Should I lock today? What are your thoughts on that? Now, you would never answer the question, but we always had a cheesy quote that was like, it's better to have locked and lost than to never have locked at all. As a way to just push them to the finish line. Professor Kessel, same question for you, but let's add a little more to that, just given your background. I mean, like, what are some, on top, so it's the same question, just what does the volatility and uncertainty mean for the market? But on top of that, like, from a hedging perspective, what should customers and owners and cap markets people not be doing today? What should they be focused on and avoid?
Well, I mean, I think that just to kind of take the first part of that question first, I mean, like there's so much volatility and there's so much uncertainty about, where the economy is heading. You could make a case for interest rates going up or going down, right? And we've certainly seen that in the market lately. And all that uncertainty, that also frustrates even purchase business, right? Because, when you have this kind of fall in equities, that whole wealth effect, and, what that might do to frustrate some of the purchase business that would otherwise be here. It's that kind of turmoil is just disrupting the whole market, even from a supply point of view. But back on the second question, I think we talked about this in maybe our last call, but when volatility goes up, to Rob's exact point, that's going to increase hedge costs. It's that chasing around pull through, the buying and selling as the market goes up and down. That leads to hedge costs. That hedge cost is going to erode what corporate margin you make and retain ultimately. And we talked, I think, the last session, the one before, is one thing to do, of course, is to try and boost your margins a little bit as a defensible, legitimate, strategy to try and still net for the company that same amount you'd expect in a less volatile market with lower margins. And I think it's just also good for owners of companies and capital markets heads just to talk about the things that change during the pipeline. Like servicing values are a big part of valuation. Whatever you originate at the front, whether you retain it and where you book that servicing, or when you sell it off to an aggregator and a bid tape. If rates drop during your pipeline period, so too are your servicing values that are going to be part of that final bid. And it's not as easy to hedge per se as the regular loan side is. So I think it's just what I advise clients is just to talk about the things that can happen, so it's not a surprise. And and to LOs, it's the same kind of thing. Get your business done, get that lock done. Don't lose the lock, to your point.
And then a quick question, just with this like level of volatility, I mean, what does that mean? And I'll just go around the horn. But what does that kind of mean for like the non-QM securitization and jumbo loans? Does this like add more with the added uncertainty? Does that widen the spreads? Like, what happens there?
I mean, it should, right? It should be widening the spreads, and the jumbo and non-QM have different indices that they might use, or combinations of whether it's TBAs and different credit spreads and lengths of treasury or swap-based instruments they use to kind of construct their pricing. But it should, right? Volatility should increase the spreads and maybe even make some of the estimates more conservative on the credit rating side. But there's so much moving around. It's really hard to say what will actually transpire.
Yeah, and Ira, have you seen any of that? Have you seen any of that outcome on rate sheets yet, or?
Yeah, we haven't really seen it here hit too hard yet. But just an example, we're locking all our jumbo and non-QM best effort. We're not taking the risk to hedge that, take any chance on, adjusting the worrying about hedge pickup on jumbo or non-QM. So we're sticking with best efforts. We think that's the best way to proceed. In the past, we've seen people get into trouble when they're trying to, bulk up those jumbos or non-QMs. I know obviously, a few years ago was a totally different animal, but we'd just rather secure our price that we know we're going to get, lock it with the investor, and just call it a day from there.
Yeah, I got it. And then on the subject of the purchase market, it's a question for you. Actually, we'll start with Rob Chrisman on this one. But like over the last couple of months, rates were ticking up, and now they're kind of coming back down a little bit. But we've got increasing inflation. Stock market's down 10 to 20%, depending what index you're looking at. I mean, what do you think happens with the purchase market as it relates to like new homes and existing home sales, especially if inflation really does tick up, we'll have material cost increasing.
That's quite a question, Marcus. We'll spend the next 3 hours answering it.
Yeah.
It's interesting. Before we got on the call here, I was writing tomorrow's opening paragraph and leading off with a story about how builders' inventory is increasing and builders are cutting prices and putting deals in their mortgages, making their mortgage pricing more aggressive or offering treats to buyers of their inventory. And so we've been in a situation where builders have not kept pace with demographic needs for many years. And so we're always talking about the shortage of new homes, shortage of construction, shortage of inventory. And now it seems like maybe we've changed a little bit because of affordability, and builders are sitting on this inventory. And so when you talk about the purchase market, uh, you've got that going on. But I would say, and maybe I'm old school, but and there's no maybe there, I guess I am old school, but if you're trying to look at what lenders might be seeing from borrowers, potential borrowers, all you have to do is put yourself in their shoes for just, 60 seconds and think about, okay, if I am a head of a household, I've got a wife, I've got two little kids, I'm living in an apartment, and the landlord continues to raise the rent, and there's a lot of uncertainty, and maybe my wife works for the government, and who knows what's going to happen there, and maybe I've got a decent job, but my homeowner, look at homeowners insurance costs keep going up and HOA costs keep going up. I'm going to be somewhat tentative about taking the plunge and buying a place, even though I really need to, because I want to put my kids in a good school district. So I think when there's volatility, when there's uncertainty, people who have thought about buying a home tend to hunker down a little bit and may not pull the trigger. They may just sit on the fence for a while longer. And you could say the same thing about investors in mortgage-backed securities, or people who are thinking about buying a car, or people who are thinking about any financial decision in this environment. If I'm thinking about buying 100 shares of IBM stock, well, gosh, I don't know what's going to happen. Look at what's happened to the stock market over the last couple of weeks. Is this the time to get in? So when people get concerned, when they get confused, when they don't quite know what to do, they tend to do nothing. Kind of like a tortoise going back in its shell to some extent. They just kind of hunker down, wait for things to settle down. And so if you talk about the purchase market, there are psychological things going on. There are also economic things going on. And this is where a good loan officer can really add value, as opposed to having, a potential borrower or buyer go on the internet and try to find a mortgage that way, or try to find some advice. That's where a skilled originator can step in and add value by saying, this reminds me of this, and these are the things you need to think about. And, rates go up, rates go down, home prices tend to go up over time, but, there could be volatility here. Here are the things to think about with regard to your family, and for that person to add value to that potential buyer. That's a huge plus for an in-person originator to have in this market.
Yeah, God, you got an amen from one of our audience members in that one, Rob. Ira, any changes in your projection for your purchase volume this year, or?
No, I mean, I think the dip that we witnessed, a couple weeks ago, 2 weeks ago or so, I don't think that was anticipated. So I think, obviously, we had a reversal of, the last week and a half of positive movement. But if you look in the long term, we're still in the same range we've been. So, some people may have been sort of teased by the little dip that we had, maybe an uptick in refinance activity. But overall, aside from the volatility piece that Rob just mentioned, we're still in the same spot we were prior to last week. We're still in a sideways, sort of level here, and I don't anticipate anything or any changes in the projections just because we saw, the little bit of volatility, because we basically are where we left off prior to the dip that we saw a week ago.
Yeah, got it. And then this is questions for Rob Kessel. I mean, this is something that I've never really been able to pull off kind of in my career at cap markets, but builder forwards, what, I mean, how do non-builders make that work? I've never been able to figure that out. From my point of view, I always think that, like, the builders themselves are subsidizing the forward contract with maybe the cost of like appliances or something. I don't know. I mean, what are your thoughts on that? And
Well, I mean, there's a couple of versions of the builder forward, and I'm happy to hear in the last year or so that there's been some more reasonable version that builders have worked with lenders on, where they're actually more on the hook for the commitment costs or the potential market move, even contractually, so that they can try and lock in some coverage at lower rates, but own the risk of that. And of course, the older school, the more traditional builder forwards, almost all of that risk sat with the lenders. And that was one of those things that lenders often thought they wanted to do, but when they really got into the economics of how you hedge that and the cost associated with that, and still the huge risk that those borrowers that could still go to another lender, it was really not in the for the best interest of the lender to offer those, even though they might get some of that builder business. So I think the newer ones I've heard about where builders are more realistic with lenders, then I think that that's something that's more appropriate for lenders to consider.
yeah, got it. Thank you.
It's a, so can I follow up on that, Marcus? Is
Yeah,
that all right?
please.
Rob raised a very good point because the fact is a lock, people forget what a lock is, right? And it's almost like a one-sided lock in this kind of environment where and I don't know if we're going to talk about renegotiations or not, but when you're dealing with a builder, and I started my career in my mortgage banking career working for a company that did union, had received union money, and then had dealt with union builders and offering forwards. And it never, ever made economic sense. You didn't even want to look at the economics back in the 1980s because the builders would pay, half a point or a point, and then the owner would pocket the money and you'd be left to hedge these loans, 6 months out or 9 months out, out then. And so the economics never made sense. And to this day, I think it's important for originators to understand that when you're dealing, especially in this kind of environment, be able to say, okay, 6 months away from, today, or 9 months away, whatever long it takes a builder to build a home, we're going to put coverage on and we're going to protect that interest rate. Well, to Rob's point, rates go down, the borrower is going to say, hey, this was nice. Yeah, I paid a point or I paid a half a point or whatever. Maybe the builder paid for that. And then I've got my credit union up the streets offering, 2% better, or they've got a great ARM program and I'm going to go do that because they offer the 7-1 ARM and it's a full percent lower than what I have locked in with you. It's really it's almost a loss leader. You're trying to, oftentimes owners of companies are trying to get originators on board who only do builder business, and they want to be able to offer them something, whether it makes sense or not, just to get that loan officer on board, or just to get that builder interested in your product. So it's almost like bond programs where, when you talk to capital markets folks about bond programs, say, you making any money on those loans? No. Well, then why you offer them? Well, we have to because, the originators want them or whatever it is. So there are a lot of headwinds in terms of profitability with builder business, and but some loan officers, they got to have it or else.
Yeah, and on that subject, I mean, when I was in cap markets, my 19-year run in that seat, to your point about bond loans, it's like loan officers had to have them. You had to sign up for them. You do a whole product launch, and then you'd maybe get 2 or 3 locks on it, and then you would get booted from the bond program for not delivering enough loans. And it was this vicious cycle of where to divert resources and how to recruit and so on. But yeah, fun times. On the subject of just kind of like the purchase market and all that, switching gears a little bit here to M&A activity. So Rocket acquires Mr. Cooper and Redfin. I think it's still in process. But now you're going to have an entity that's going to basically have from the start to finish, right? The home search, the financing, the servicing. I mean, how big of a threat is this to everyone not named Rocket? We'll start with Ira.
Yeah, I mean it's obviously dominated the news prior to all this tariff news, but um, like you said, they sort of have a model where in-house from start to finish, right, including the servicing. And I think that recapture thing is probably the top thing on my mind, um, with letting our originators know, listen, they're going to be servicing, I think it's 1 in every 6 loans in the US now, or something like that. Now's the time to get in front of your borrowers. Realize that obviously Mr. Cooper was great at it before, but now, they have an even more powerful brand. And so my focus has been really on that recapture piece and letting people know, be prepared, keep in front of your borrowers. Um, you know, you would hope that maybe, if we do see rates come down, that maybe that recapture business will be too much for them to handle. One can argue that, but just keeping aware of refi opportunities and sort of keeping in great contact with your borrowers and not sort of tempted by that branding.
Cool. Yeah. And then for Rob Kessel, same question to you, but let's add on to that. Like, does this change kind of maybe the philosophy of loan sales or co-issue or MSR sales at all?
Yeah, well, it should, right? I mean, because lenders, they that are selling on a release basis, the different investors have different repurchase or solicitation agreements and clauses, and then they have different efficacy and how good they do it, right? And if Rocket was at high 80s of recapture, I mean, that's insane. And like how are you getting, as the LO working for the lender, how are you going to get that loan back? And for anyone who was selling to Mr. Cooper, now going to Rocket, and Mr. Cooper wasn't bad at it either, right? And recapture, I mean, that's like a significant strategic issue for company owners and for loan officers, on who they sell to. And the flip side of that is what's going to happen with Quicken or Rockets, their book of business, right? Like when they sell whatever they're selling from a security point of view, spec payups and whatnot, they have much higher speeds. The investment community has to consider that they have higher prepayment speeds, so they can't pay up as much from a payup or a spec, a story point of view. That's going to impact their execution. So yes, certainly lenders need to be thinking about that, how that Mr. Cooper relationship plays out with Rocket, and even what the other lenders are doing. I think everyone can hope that when rates drop, that Rocket can't necessarily keep up, but certainly everyone at Rocket's incented to figure out how to scale to the next level. And if anyone's going to do it, they're a good contender to figure out the maximum amount of scale.
Yeah, and then Chrisman, same question for you, and to kind of add to that, do you see anyone following in this strategy footstep, or whatever you want to call it?
Well, of course, you guys saw the news that BlackRock just bought Freedom, right? No, I'm just kidding. Just kidding. Just kidding. Just kidding. But if you think that some of these very competitive business owners are just sitting on their hands or wringing their hands saying, woe is me. Oh my gosh, the world is going to be taken over by Rocket. First of all, the market is still very spread out. If you're thinking $2 trillion this year, if you look at the market share of the top folks, it's still in the single digits. And so it's a very diverse crowd. But if any originators are sitting there saying, well, I send my borrower a turn your clock, change your clock. I send that out twice a year. And that's how I stay in front of them. You can be guaranteed that that borrower is receiving other much more useful and informative information from who's ever servicing their loan, whoever bought that servicing. And so the borrowers are out there being bombarded, or at least reminded a lot of who's servicing their loan, and maybe that company knows more about their credit profile. Like, hey, we notice your credit card debt has been creeping up, or I don't know exactly how that might work, but hey, if your credit card debt is creeping up and you're probably paying 25 or 30% on your credit card debt, and we know that you have a 3% loan with us, and so we can, help you, and this is how we're going to help you. You've been doing a great job making your payments. They have a lot of information, and whoever bought that servicing wants to use that information to their benefit. And so the loan officer who's thinking, okay, well, you know what, our kids went to elementary school together, so I've got that borrower in my back pocket. Nah, I wouldn't be so sure of that. It is a personal business, but really the information that the servicer has right now, in this case, Rocket / Mr. Cooper, is tremendous. And so it's going to take a lot more effort, I would say, if you're Rob Chrisman, LO, working for, Rob and Marcus's mortgage company, and we don't own any servicing. It's going to take a lot more work on my part to stay in front of that borrower and get that business.
Yeah, got it. And then do you think the current regulatory environment in being kind of stripped down a bit, do you think that has made this whole acquisition like significantly easier? And you think that'll change maybe future acquisitions kind of in the industry?
Me?
Yeah.
Yeah, I'm sure discussions are going on right now, and whether it's a loan officer talking to a competitor, or a branch talking to a competitor, or a mortgage broker talking to a competitor, or a big branch talking to a competitor, or an entire company talking to another company. I'm sure those discussions are going on all the time, every day, all week long, all month long. And so uh, the mergers and acquisitions don't show any signs of letting up, and we're just waiting for the next big deal to come through.
Yeah, I got it. I want to switch gears now to special purpose credit programs. I actually have a really hard time saying that, as SPCP was called that. So, I mean, FHFA Director Pulte eliminated these programs, and let's start with you, Ira. Like, how big of an impact is this? I mean, what does this mean for lenders, home buyers, and what's an alternative at this point?
Yeah, so we have a couple of things. Number one, we saw his Twitter release about the removal of the SPCPs, as you said. So there's sort of two things on this topic. Number one, we didn't have any special purpose credit programs. We are not a bank. We're an independent mortgage banker. Obviously, we did have access to the Home Ready, Home Possible grants that were attached to those programs. So I hate to sort of, you know, agree with removing them because it's obviously it serves a purpose, especially for underserved communities, low to moderate income borrowers, and there were a lot of good programs. Um, One point I do like to make, and I've spoken to Fannie about this numerous times, using them as an example. There were programs offered by larger lenders, maybe, that us as an medium-sized independent mortgage banker did not have access to. And when we talk about all lenders being on a level playing field, that was not allowing us to be on a level playing field with some other lenders. So those programs being eliminated puts us at a little more of a competitive edge with these companies now. Using the Home Ready First program as an example, which gave a $5,000 grant for certain MSAs, we were not able to access that program. Well, now no one's able to access that program. Is that a good thing? No. But try and grab anything positive out of this news is that maybe we're at a little more of a competitive advantage compared to where we were a couple weeks ago.
And this is like me asking because I generally don't know the answer to this question, but is like the core Home Ready and Home Possible product, is that impacted, or is that still alive, or do you see that going away at some point?
As of right now, they're still alive, but you never know, what's coming down the road, whether it's changing LLPAs, whether it's changing programs, affordable programs. We'll just have to keep our Twitter accounts, active and on notice.
Yeah, and
Is Twitter still a thing, Ira?
I
Is there
still call
still a
it Twitter. I mean, I've been on Twitter since 2007. I'll still always call it Twitter.
Okay.
But I literally have to keep checking Pulte's Twitter account for updates. It's kind of crazy.
yeah, I mean, you used to be able to tweet. I don't know what you call Xing now, but whatever that is. Rob Kessel, same question for you, kind of your thoughts on home ready and home possible. And then on kind of given your background, also like what are the risks with hedging this product? I mean, I looked at our data, kind of every lock run through the poly system before this call, and we have locked, our customers have locked a lot of home ready and home possible. And it could be subject to like a violent overnight change. I mean, what are your thoughts on hedging that risk?
It's an absolute concern, right? Because it's not just the forgiveness of the LLPAs or the lack of LLPAs, but it's also the spec pay-ups on the back end that a lender may be passing through and pricing and rate cheap pricing. So it's, I mean, ideally, you'd hope that the regulators would, in a measured basis, announce, with 2-3 months out, we're going to make this change, so that a lender's pipeline can, plan for that and not price expecting no LPAs and, no pay up on the end. And that's the hope. But, it certainly has happened before where changes have been made that have impacted loans in the pipeline to where they've represented a loss to the lender. And it's one of those kind of risks they take on when they're hedging a pipeline, when they're not able to sell their loan straight out of the box. It's a policy tool that the government has as far as promoting home ownership, first-time home ownership. The other kind of de facto policy thing we have is a big GFI that's shipping a lot of money to the Treasury from Fannie and Freddie. And who knows like where that money, what that even means is a balance of account if there is another big credit problem with Fannie and Freddie. So I think, I still come back to where I think that if we're talking about affordability of housing, cost of housing, inflation, there's still some opportunity with the agencies to say, hey, maybe let's not cross subsidize certain credit and let's not cross subsidize the Treasury. Let's think about how we could make housing more affordable with lower G fees.
And then Rob Chrisman, I'll kick it over to you. Same subject. Sorry. Well, same subject on just home ready, home possible. Like what are your thoughts on the future of that product and home affordability products?
I think that obviously the business is cyclical. I don't really have much to add to what Ira and Rob already, discussed in detail. The first time home buyer was a priority, I would say, or underserved markets, or that kind was more of a priority in the prior presidential administration, much less so. But things could change. So
yeah. With the last few minutes here, I'm gonna do a quick roundtable, and if you want to chime in on the chat, that'd be great too. But kind of the way I think about inflation. So switching subjects here real quick. So tariffs are inflationary. I do think inflation is going to be uptaking. We're already kind of seeing it in car prices and everything else. With the Fed's kind of mandate to fight inflation, do you think that they're going to pause rate cuts this year? And we'll just go around the horn and quick 30-second answer. We'll go with you, Ira. We'll start with you.
I don't think necessarily going to see a pause throughout the year. I think next meeting, I think it's May 7th, we will see a pause. We've been sort of penciling in that June meeting as sort of the first indication of a cut. Last I checked, it was still sitting at pretty fair odds for a cut. So I think we'll have, more information as we get closer, but I just don't think we'll see any change in the next meeting. And you could just take it, one by one. If you could take a look at the 2-year Treasury, which we're sitting at 3.67. So that's sort of, a focus where we'll be in a year. It's where we're trading. So I don't think we'll see a pause throughout the year, just at least in the next meeting.
Kessel, kicking over to you, same question.
I think that there's so much uncertainty about how many different things could play out that could kick a recession in earlier, and so it's, I think you could put anything on the table. You could say tariffs push through, and we see that in pricing, and that we'll have to respond to a reversal possibly on Fed policy, to where you see enough headwinds and enough recessionary signs that they're going to have to act, and maybe might want to act aggressively sooner. So. No clarity in my tea leaves on this one.
And Rob Chrisman, if you're a betting man, what are you going with?
I can't believe Rob Kessel is unwilling to take a stand, unwilling to predict the future. It is impossible to predict. Echoing what Ira and Rob said, because unlike previous market moves, when you're dealing with an individual, and whether you like Donald Trump or you don't like Donald Trump, when one person has as much influence and sway and control over what he does in terms of the world's financial markets at this point, it really is amazing. And it does open up the markets to I won't, not necessarily mood swings, but, whoever talked to the president last, or whatever that the president may have watched on the news, or whatever thought occurred to him. And when you're dealing with an environment like that, and you're the Federal Reserve chairman, or you're the Federal Reserve Open Market Committee, it's really, really difficult, if not impossible, to try to figure that out. A lot of people say, "Oh, well, the Fed will act and stifle the effect of the tariffs." Don't be so quick. Don't be so quick to say that, because the Federal Reserve is in the same boat as many of us in terms of not knowing exactly what's going to happen. And there's only so much the Federal Reserve can do in terms of combating inflation that's caused by, egg prices or cocoa prices, or in this case, tariffs. So it's a very, very difficult environment. I wouldn't want to have to predict interest rates at this point.
Yeah, I got it. Well, cool. We're at time, and Rob, and Ira, thank you as always for being on this panel and everything you guys do. And thank you for everyone who dialed in. And have
Thank
a
you,
great
Marcus.
rest of your
And
week.
thank
Yeah.
you, Polly. Let's not forget Polly here, for gosh
Yeah.
sake.
Yeah. Thank you, Polly.
Yes, thank you.
Thanks,
All
everybody.
right. See
Thank
you
you.
guys.
Bye.